Good morning, and welcome to our first panel on fixed income. It's my pleasure to introduce the panelists this morning. The panelists will cover everything from investment grade, global credit markets, distressed high yield, and private debt, private fixed income strategy used by many investors in the Canadian market. But it's my pleasure to introduce Richard Pilizov. Richard is a managing partner and chief executive officer at RP Investment Advisors. RP Investment Advisors invest predominantly in investment-grade bonds that trade in liquid global markets. Richard is a former managing director and head of global debt markets at RBC Capital Markets, and has held several other senior positions in his greater than 25-year career at RBC. Alan Weiner is the president and co-founder of Harbor Mortgage Corp. Harbor Mortgage Corp is a non-bank lender that provides capital for commercial real estate properties across Canada. Alan is responsible for Harbor's overall operations, including investment decisions and capital commitments. A commercial real estate lawyer, Alan has over 25 years experience in real estate and business investing in financing, acquisitions, dispositions, and joint ventures in the Canadian market. And finally, I'd like to introduce Barry Allen, who is the founding partner of Merit Asset Management. Merit Asset Management is one of Canada's largest independent managers of fixed income credit, focusing on high yield and investment grade corporate debt assets. Barry has over 30 years of experience in investing experience and successfully operated in every area of fixed income, including alternative investment strategies. So welcome. So I'd like to kick off the panel this morning by opening a question for everyone, which is, where do you see the greatest opportunity in fixed income investing today? Barry, we'll start with you.
Well, that's relatively easy because there's not a lot of value, in my opinion, in many things in the world today. We're undergoing an extraordinary period in financial history where markets are being artificially influenced dramatically by central banks. And that is creating situations where valuations are relatively extreme in some areas and are supported in other areas. So it's a very unusual. There's never been a period in financial markets where central banks have committed to keep interest rates bound at zero, and even more importantly, between the European Central Bank and the Federal Reserve in the United States have expanded their balance sheets by nearly $7 trillion in the last 3 years. Those are just extraordinary policies and extraordinary amounts of money. And what it's doing is forcing capital into asset classes that probably that capital in normal circumstances would be in safer investments. So I would say that the best opportunities that I can find in the world right now would be in the areas in the resource areas in debt of mining and energy companies, because in the high yield market you can still get 8 to 10% or even more than that in some of these companies that are have relatively strong balance sheets. They just have very, very volatile cash flows. But most importantly, I would say that we're in a world where relative value is the most important thing. And what I mean by that is, I think there's very good opportunities to be long something that is relatively less valued, and short something that's relatively higher valued. And just as a pure example, The government bonds of virtually every reasonable country in the world are massively overvalued relative to inflation expectations. But I think that there's extremely attractive AAA investment grade balance sheets, blue chip names like Procter & Gamble and Johnson & Johnson and so on, where the spreads that you can receive on a AAA credit relative to, say, a U.S. Treasury bond is really attractive, but the risk is that interest rates go up. So you need to be long the AAA corporate and short the thing. So we're very, very much, I think, in a relative value world where, you know, for the last 25 or 30 years or almost my entire career, most of the money was made on a bet on directional movements in interest rates, but that's no longer true right now.
Alan?
So we're a much more micro asset manager where our focus is exclusively in the real estate market. And so we focus on the Canadian and some aspects of the U.S. real estate market. And despite what the newspapers talk about as a bubble, and people automatically assume that it relates to every market and across the country, our country is made up of many different markets, whether it be Western Canadian, Quebec, or Ontario, and as well as different asset classes. And not all of them have this stigma attached like the Vancouver and Toronto condominium markets. And our focus is on three aspects of those markets. Firstly, it relates to we have a first mortgage fund where we have a diversified portfolio of first mortgages on Canadian real estate, and where conservative investors can get yields of 7.5% to 8%. And there are a lot of these products out there today where many new entrants have started first mortgage funds, whether they be in the form of trusts or MIC, and we'll talk about that a little further later on. But again, it's looking to conservative investors who are looking for diversification across asset classes and geography. Secondly, we do syndication of higher yielding product. And in that case, we're looking for yields in the 9 to 12% range. And these are, in many cases, structured financings where we structure them with a Canadian financial institution, and in other cases where we do either second mortgages or mezzanine debt on construction loans. Again, we look at each market, and whoever's investing in these look at each market in depth. So right now, some of the stronger markets may be, whether it be Ontario or Western Canada, you're looking at each market very specifically, in each class very specifically. And the last investment vehicle we have is a syndication of equity products where we do joint ventures and participating debt with strong developers, again, across Canada and the United States, and where investors, this is focused on investors who are prepared, obviously, to take more risk, because you've moved from the least risky asset to now the more risky asset within the real estate capital stack. And investors in this look for yields in the 15 to 22% range.
Alan, just a quick question. When you say developers, are you going, does that include condominium developers, or those are the types of projects, or is it
It could, but for example, it would be in Edmonton. We're just finishing construction of a 143-unit apartment building with a developer,
right.
And so we're leasing it up and then financing it out. But it also does include condominiums, just in our case, not in certain downtown Toronto or Vancouver markets.
Right. Richard,
thank you.
over to you.
So I'm just trying to focus on the opportunities we're seeing this year within, RPIA really focuses on the investment grade and a small bucket on high yield. Just to go back to last year, obviously it was a very difficult year in terms of the overall market environment. A lot of concerns on the financial space in the U.S., really on the understanding or poor understanding of what the balance sheets were really like when you dug deep. And then obviously on liquidity issues, dealing with the European crisis in terms of the overall counterparty risk associated to, for example, U.S. banks, and then obviously the overall capitalization some of the banks in terms of having low tier 1 ratios, and some of the issues as they move into Basel III or the change in regulation. So last year, for example, we felt that spreads of financials in the U.S. were undervalued, really on the basis that a lot of the banks, like you're seeing UBS announcing yesterday, are continuing to downsize their more risky operations, their trading operations, and becoming back to where they were many years ago, and reducing their leverage ratio. So we saw that as a great opportunity, and we very much focused around U.S. financials on a relative value basis. As Barry was saying earlier, government bonds are, I believe, are priced on an artificial basis. So from our perspective, we wouldn't own a government bond beyond 2 or 3 years. I mean, I think it's probably criminal to own a bond outright right now in the 5 or 10 year space, or even long space, because I think that when it's hard to predict what rates will do in the big picture, but I don't see how we get paid back when you own a 1.4, 1.5% 10-year bond. So as we go forward, and Barry and I do some similar things in terms of relative value, the greatest opportunity we see now is Europe, okay? We're not looking at European government bonds, but we're focusing on, we call them the national champions of Europe, and I'll just give you a couple of examples of investment opportunities we're looking at there, and which we're involved in the last couple of months. Telefonica, a telecom in Spain, but with actually a lot of its income and market presence outside of Spain, and I think that's in certain ways poorly understood. Their debt-to-equity ratios are comparable to a Rogers Cable in Canada, but their spread is trading, a multiple of what a Canadian telecom spread is trading at, and that's because of the so-called European crisis. And another example would be Santander Bank, another global bank. It's got huge operations in the United Kingdom. It's got operations in South America. Its Tier 1 ratio is the same as J.P. Morgan. But again, it's being sucked into the European crisis. Now, clearly, there are risks associated to Spanish mortgages, and there would be associated to a risk to Telefonica being downgraded by one of the rating agencies. But I don't want to focus on rating agencies because I don't think that some of what they are looking at is clearly more defensive, and I wouldn't believe in rating agencies how they rate things today. But these are examples of companies that we think offer extreme value, and on a relative value basis would be companies we'd own in our portfolio. We obviously, as mentioned earlier, we're not comfortable in terms of where government spreads are, so this is a trade where we would actually, as Barry used the word, relative value. We would short the government spread, and we'd be long the appropriate securities in this European champion space. And that's what we're focusing on. I was in London last week, speaking to a lot of the banks, and looking for 15 or 20 of these European champions, and those are a couple of examples we think offer compelling value in Europe right now.
Great. Thanks, Richard. The next question's for you as well.
Oh, really?
Given that the performance of investment-grade fixed income securities over the past decade has brought historically high levels, can investment-grade bonds be considered a relatively safe investment?
Well, as mentioned the theme earlier, there is a tremendous amount of value in the investment-grade space. The problem we have is some of the companies that Barry was mentioning, for example, earlier, which are phenomenal companies, they are AAA companies, is they're trading at such a tight spread, okay? And so the issue to us is more the pricing of the security versus is the investment-grade space or is an investment-grade security safe? They are safe, and especially if you look at the top 100 companies in the United States or some of the larger companies outside the United States and Canada, you're going to get your money back. Then the issue becomes, okay, are you being paid for the risk associated to owning, Procter & Gamble 3-year bonds at, 70 basis points, okay? So the issue then becomes the risk reward. So what we do is, as I said, we look at relative value, we look at the indexes in terms of where they are on a historical basis. Right now, the market's fully priced in our view. It's hard to find compelling value in North American high-quality credits, even financial credits, because they've run their course and people have already priced them into being a safer security. So again, we look through the rubble and we try to find securities that are mispriced. Going forward, other than Europe, I think the next opportunity will be as we see banks continue to rearrange their balance sheets, and we see the contingent capital securities, which are securities where the regulators would like banks to actually have supplemental debt that could be forced into equity, so the so-called senior debt holder will not be seen as holding the bag if something went wrong. So again, they're investment-grade securities, but we will be looking for a new area of securities to be able to invest in the future. So that's something that we'll be looking at.
Thanks, Richard. The next question is for Barry. Compared to other fixed income markets, the high yield market has been prone to widely oscillating prices and emotions. Which state of the market, euphoria or despondency, is more risky for high yield investors, and why? And in your opinion, where are we in the spectrum today?
Well, in the financial markets, euphoria is always the most dangerous because when everybody agrees that something is unconditionally loved, which you're supposed to keep that for your children, not your investments, then something else is highly likely to happen. The last time I would say that the high yield market was experiencing euphoria was in 2007, where high yield credit spreads were a little over 2% versus the long-term average of roughly 5%. And we all know what happened in 2008. The credit spread in the high yield market went from 2% to 22%. And the market or the indices had negative returns close to 30%, which actually wasn't bad given the stock market went down 40% to do that. So, there is always degrees of euphoria and degrees of despondency in every asset class and every part of markets. Where we are today, I wouldn't describe the high yield market as experiencing euphoria because the credit spread is roughly, 5.25%, 5.5%. Which is about in the long-term averages, but the absolute yield in the high-yield market is 6.25%, which is a true record low to do that. And people are buying high-yield bonds not because of euphoria. They're buying them because there is no other reasonable alternative. And so buying them because the central bank is forcing interest rates so low that they're pushing capital into riskier asset classes is probably a better reason to buy than because of euphoria, but it's not a good reason to buy. I think that the high yield market is relatively highly valued right now. And will likely undergo some correction in the next year, but that correction will be not related to the credit quality of high-yield bond issuers. It's more related to the volatility around sovereign debt and government balance sheets. So, we're in a situation that we haven't seen before, but I would say that if history's any guide whatsoever, we're facing likely a decade of deleveraging of government balance sheets. And in that environment where you have relatively weak economic growth, low interest rates, and occasional scares on interest rates, but not secular rise in interest rate, in that environment, high yield tends to be a very, very highly performing asset class relative risk-adjusted versus equities and absolute relative to investment-grade credit. So I don't want to be, I don't like the valuation of high-yield bonds today. Longer term, I remain really positive on them, and I don't want to get too bearish. Because essentially the central banks of the world are saying we are going to do whatever it takes to avoid a severe recession, whatever it takes. There's no way that anybody could have envisioned the ECB and the central bank or the Federal Reserve, expanding their balance sheet by $7 trillion in the last 2 or 3 years. Those are just extraordinary things. So we're in a different environment, and I think it pays to be cautious right now, but longer term, the high yield market, I'm pretty positive on.
Great, thank you. We're going to shift back into the real estate market. Questions for Alan. In the U.S., easy credit on mortgages played a large role in the real estate bubble and the crash that subsequently followed. Many people in Canada, particularly in Toronto, have speculated the real estate bubble here, particularly regards with the condominium properties. Have you noticed any excess loosening of credit policies for real estate assets over the past decade, or do you believe it's merely a healthy, robust credit environment?
So I think the more interesting question relates to the bubble than it does to the credit policies, because I think if you take a look at our financial institutions over the last number of years as the market has heated up, other than some aggressive loans to the best capitalized borrowers, they have been relatively disciplined in their lending criteria. And I don't think we're going to see anything like we saw in the US, where the lenders were, as lawsuits have shown, were reckless in their policies. We don't see it in Canada. We have lenders, the Tier 1 and Tier 2 lenders, who are very conservative and very disciplined in their approach. I think the interesting discussion, and it's one I've had with a few people earlier today, relates to the nature of the bubbles, whether it be in the Vancouver or the Toronto market. And I guess, first of all, I'm the wrong person to use to gauge the timing of this bubble, because 3 to 4 years ago, I would have told you that the residential market was fully valued. And since then, it's gone up significantly. That having been said, I don't think we're in for a type of correction that they saw in the United States. I think what you'll see in those larger markets, and we're already seeing it, many of the projects that have been announced are not going ahead. And that's because of a number of factors. But we're not seeing prices go down. But I think over time, we'll start to see prices go down, but I think it'll be a moderate and a slower decline. I think you have to understand a bit what happens in the two markets we've talked about. So first of all, the Toronto market has a net population growth, where immigrants continually come in, whether it's from Canada or from outside of Canada. And secondly, a majority of the new condominiums are being bought by investors, who in turn rent them out and carry them, and they're usually flat in terms of the income they receive. So that's what's putting the pressure on the units to continue going forward. It's not ultimate buyers deciding 4 years in advance or 3 years in advance to buy a condominium. It's people who are investing or speculating in the markets. So what's putting a brake on those today? And I think the first brake that started coming was from the regulators. The regulators saw this problem, they went to the financial institutions, and they started putting brakes on. And therefore, you're going to find a lot of Tier 2 developers will not be able to get construction financing anymore, and if they are able to get it, they'll have to put in a lot more equity in order to move ahead with their project. The second thing that's happening is CMHC is tightening their criteria, so borrowers aren't able to borrow as much, and therefore they're not going ahead and buying. And I think the real ultimate test in our market, and it's the one that's going to see how easy the decline is going to be interest rates. If interest rates go up, someone's bought a condominium, suddenly they're underwater on a monthly basis, there'll be a lot more units flooding the market. And also people who are highly leveraged within their homes will not be able to afford it. So if the government continues on their low rate policy and they only gradually increase it, I don't think we'll see a big change. But once you start seeing interest rates go up, all bets are off in terms of what's going to happen in an overheated market.
Yeah, what I'm seeing is the credit market is having a little bit more discipline with a lot of the conservative lenders pulling back loan to value, specifically in outlying asset classes like hotels and self-storage, anything that is maybe not right down the middle. Loan to value would have gone from about 65 down to 55. So, we're seeing a little bit pullback of credit in the conventional market.
Therein lies the opportunity.
Yes, yes. And the CMHC, them pulling it back and being slow. So the next question is for Richard and Barry. To what extent do the fiscal stimulus programs in the U.S. and the EU affect your investment strategy? And how can investors proceed with caution?
Like me to start? Or?
Yeah, go ahead.
Go ahead.
Well, I think it's, as Barry mentioned earlier, it is a very difficult environment to look at the clear picture that there's an opportunity of significant magnitude right now, because when you look at the true valuation of a government security, again, coming back to what we said earlier, it's very hard to justify that a government 10-year bond should be trading at 1.5%, or that an overnight rate in the U.S. should be 0. So, as we said earlier, the government, the U.S. Fed, has pumped an enormous amount of liquidity, and we're getting comfort in the fact that the liquidity will be maintained in the near future, which is probably one where we try to figure out what is the next big shoe to drop. It's hard to assess when the election actually is resolved in the next week. Will Bernanke be in his seats? And he's obviously been the big proponent of QE. So I think there's a lot of uncertainties to go on in the U.S. In certain ways, actually more uncertainties in the U.S. than there are in Canada. Than the U.S. than there are in Europe. As much as Europe is a big issue where people have continued to be very cautious on, I think that the leaders there, even though it's going to take years, are on the right path. The LTRO, which is the program that the ECB put together, really was a changing point for Europe. Same idea as what they've done with the Federal Reserve pumping overall liquidity. That, for us, helped us assess that there was plenty of liquidity, in again, mentioning quality European corporates, that would be provided in the system, and therefore if banks had the liquidity, they can provide that back to their corporate clients. And so most of our strategies, then we look at investing, were under 3 years. And the 3-year term was the term we felt was the level where liquidity was provided, with abundance. From that perspective, we felt very comfortable to look at using some leverage to buy shorter dated securities on a global basis of high quality companies. So I think still, when you look at the overall rate of an investment grade or an overall bond, one has to be very cautious, assume that the overall return is going to fulfill one's investment profile going forward. So for our perspective, again, as mentioned earlier, we're looking at the relative value of a security, it'd be in Europe to the US, or it'd be against a government to an overall corporate spread, and then applying a relative value. So liquidity is abundant right now. In Europe, I think we got clarity that it's going to remain abundant. In the US, we know the Fed's there now. One, again, mentioning earlier, it's uncertain to see after the election at what point in time that Federal Reserve stance might change. If it does change, I think it would be, very difficult to look at the valuation of U.S. equities, for example, and U.S. debt as being cheap. So we'd have, from that perspective, we'd be very, very cautious.
Okay. Well, I'll give you kind of a little 4 or 5 step roadmap to how we look at it. There's 2 Harvard professors called Rogoff and Reinhardt wrote a book about 5 or 6 years ago called 800 Years of Financial History. This time it really is different. And it's extremely painful reading this book, I can assure you. But you don't have to read it, because I'll tell you that they make 2 conclusions. The two conclusions are that every banking crisis in history has been followed by a sovereign debt crisis. We had a true banking crisis in 2008, and now we're in a sovereign debt crisis. So they're completely correct. History is following at this time. The other thing that they conclude is once governments get over 90% debt to GDP, that's when problems start to happen and solvency starts to creep into a component of bond yields rather than simply inflation, which is generally what drives a yield on a government bond. So I've spent an enormous amount of time studying sovereign debt problems around the world, and we've had all sorts of them. And they're almost completely similar. And there's two and the roadmap is how do we come out of this and what's going to happen. What's different about this time is that 70% of the world's GDP are now, their governments have debt to GDP ratios in excess of 90%, which is the danger point. In previous times, in the early 90s, coming out of the 1991 recession, Canada had a sovereign debt crisis. Sweden and New Zealand were in that same camp. We had countries like Argentina. We had other countries around the world in Latin America that had sovereign debt crises and so on. But those were very isolated situations. Now it's a global problem. So what's important to know is we are in a global sovereign debt crisis today. It's a three-legged stool. It starts with Europe, and it includes Japan and the United States. And the history of these things is, a lot of people come out and say this is going to end up in inflation. I've looked at history, and the countries that have tried to reflate their way out of sovereign debt problems, no one has succeeded. The countries that have tried, like Argentina and Zimbabwe, or the Weimar Republic after World War I, have created hyperinflation and have defaulted anyway. So for every guy that tells you the only way out of this is inflation, history suggests that that is not true. It is not the way out of it. The people who have succeeded, like Canada in the 90s, are the people that took the austerity route. And it's not fun, and it's not easy, and politicians don't like hard decisions. But the facts are that what does work in history is austerity. Governments simply have to do what any of us in this room would do, and that is spend less than we make and use it to pay down debt. This concept of reflating your way out of a debt problem is a nice economic theory, but there's no basis in history for it being successful anywhere, and it's extremely dangerous. So the question is, are we going to end up in a big inflation problem or not? I don't believe so. I think we're going to go through a decade of deleveraging and weak economic growth and painful adjustments, just like Canada did in the 90s in the United States. But we are going to have periods of time when the markets are going to fear inflation. So I think you have to look at it and say, what's the likelihood of a secular rise in inflation or a secular rise in interest rates? I believe that will come, but I don't believe it's likely to happen in the next 5 years or maybe even 10 years. The last time the U.S. government had a 120% debt to GDP ratio was right after World War II, and we had 2.5 decades of financial repression, 25 years. Financial repression is negative real interest rates and negative real wages, where savers are being punished, just like we are today. And it took 25 years for inflation to actually show up. So I can't buy into a secular rise in inflation, within a reasonable time frame, and therefore, I think you have to more likely expect interest rates to stay low and look at the world from a relative value basis rather than, a directional movement on interest rates.
Thank you. This is my last question for Alan, and then we're going to ask for to receive questions from the floor. So you have approximately 4 minutes to think of a good question for our panel. So Alan, have you noticed an influx of people raising capital for mortgage lending in Toronto? And what kind of challenges does this type of activity pose for investors?
So I think over the last number of years, we've seen a large number of both public and private vehicles being created and being sold to the market. And I think this is a time for people to tread cautiously. In most cases, they're blind pools where you do not know the quality of the investments. And secondly, there's not quite the same transparency as there is with REITs, for example. When you take a look at REITs, they'll tell you the assets, the major tenants, the term of leases, et cetera. In mortgage lending, you get much more limited detail. And in some ways, it's similar to the early REIT days when there was very little differentiation between REITs based on the quality of their assets or the quality of their management teams. Now, I think you have to keep in mind that most of the vehicles, including ours, invest in similar products. They are transactions that are not being done by financial institutions, whether they be because the asset type, the borrower quality, or the loan amount is such that the financial institution will not do the loan. Now, that does not mean they're not good loans, and in most cases, there have been very limited loan loss in these vehicles. But I think we have to wait and see until there's some track record before we understand the quality of the loan portfolios, the loan loss records, and the actual returns. So what I would recommend is stick to the strongest management teams who have a long record of lending in the space they're currently lending in. The other challenge is the market may have raised too much money for these vehicles. There's a limited market for B lending product, non-financial institution. And so where there's too much of these and people are sitting with cash in their tills, they have two choices. They either become more aggressive on their lending criteria, or they lower their rates to win deals and start competing in effect with the tier 2 lenders. And I think we have to stay tuned and see what happens over the next couple of years to get a better picture as this industry matures.
Yeah, no, I agree with you that a lot of the public vehicles are not pricing the risk properly and being very aggressive on pricing seconds in the real estate market. We're seeing that.
The pricing isn't what would bother me as an investor, so you get a slightly lower return, but I think it's where some are more aggressive in their lending, which will lead to losses, could be the bigger market challenge.
Right. So now I'm going to open it to the floor for questions for the panelists. Come on, someone step up. Yes.
Well, it won't be good. The question is how, to what degree it impacts on that, and as I said, historically, what happens in these deleveraging environments is we have not necessarily negative growth. It isn't a negative economic scenario, but it's very, very weak economic growth, which makes it very hard for the governments to deleverage their balance sheets. I mean, Canada went from 90% debt to GDP to 50% during the 90s. But the decade of the 90s was one of, probably the best decade of economic growth we'd seen in 50, 60 years, where US GDP averaged 50% higher than the 100-year average, and interest rates and inflation fell every year. That's not what's supposed to happen. What's supposed to happen, if GDP is strong, interest rates are supposed to go up. But we were starting from a very high level in interest rates, and we had some extraordinary events happen, like the breakdown of the Soviet Union was a very, very disinflationary impact for the world, because it unleashed 150 million highly skilled technical workers on the world's labor force, and lowered wages significantly. And the invention of the internet and PCs and cell phones increased productivity dramatically, which actually lowers unit labor costs to do that. So I think that the thing is you can expect not negative outcomes, but modest growth and weak economic growth and shorter economic cycles and periodic things. But in terms of real estate specifically, that's just one component to it. The other component is immigration and so on. And I expect that the immigration and the flow of capital to Canada to be extremely positive for Canada. The amount of capital that's going to flow to Canada from places like Latin America, the Middle East, and Asia in the next decade, I think, is going to be dramatically larger than what we've experienced in the past. For all the things that Canada, all the resources that Canada has, we have a stable banking system. We have a rock star central banker who's acknowledged as one of the best in the world. Canada is a very, very attractive place, and I travel around the world, and everybody is very, very positive on Canada. So, we may see corrections in the real estate market. We'll see corrections in the financial markets, but I don't see any reason to be materially long-term secularly negative on what's going on in Canada. Quite the opposite.
Next question. Yes, we'll bring you a mic. There's one right. Yes.
It's really a question for Barry and Richard, maybe even worse. In terms of all your remarks, guess what hasn't yet been addressed is whether or not you have any thoughts on what might happen to Japan, which has a debt-to-GDP ratio of well over 200%, whether or not there are other macro risks that lurk that you don't think are being taken into account. For example, a breakup of the Eurozone, and what may or may not happen to China in terms of whether or not you believe they're, is vulnerable to a banking crisis.
Yeah,
That's a long question.
That's a lot of questions. Well, why don't we break it down in pieces, and then maybe Barry can take on some of it. I mean, I don't really follow Japan, to be honest, that actively. I mean, Japan to me is a market that is quite mature and probably was, as we probably all know, very slow to react to some of its issues and is this stagnation for many, many years to come. So the lessons probably there are that, what the U.S. did rightly or wrongly was at least to be proactive and create as much liquidity as you can. So that's probably a lesson in Japan is probably in this crisis for many, many years. Europe is one where, again, when you talk about these long cycles of what's going on or long cycles of what the real estate market might do, you can get really negative, okay? And you can get yourself really deep into so-called depression, your own depression about investing. And obviously that's why there's such a significant amount of cash. So from our perspective, we're trying to figure out, within all this rubble, where are the opportunities? And again, as mentioned, this whole issue about corporate champions in Europe. So right now, the way it stands, the way I look at it the next year or two, I think there's a commitment by the politicians in Europe because I think there's too much cost associated with the breakup. So our view would be that we're more constructive, that they're making the right steps forward into our own investment philosophy. There might be these bumps that create another phase of one's perception that we're going to go back to a breakup again, okay, or a smaller EU. But at this point in time, it's hard to predict. The steps are in place right now for maybe a closer banking regulation and a situation where there's more support from the central bank. But could there be a breakup of the EC, of the euro, the euro nations? I think at the end of the day, there will probably be a smaller group of countries that are working together to a common currency. But for the time being, I'd say I'd be more constructive. I think Barry's more of an expert on China. I think you spent some time over there, Barry, so maybe you can comment on that.
Yeah, well, let me start with Japan, because it's really easy. There's no hope for Japan. I've spent a lot of time looking at Japan, and I think that they're going to default on their debt. There's no way that I can come up with a scenario where they lower their debt to GDP ratio. In Europe, it's tough, but I can come up with a scenario, and I think that they're quite a long ways along. I'm like Richard, I'm also relatively constructive on Europe. The U.S. is the big problem in the world, but the U.S. is the easiest to fix. If they'd stop arguing about fixing it by either raising taxes or cutting spending and look at the facts are very simple. You have to raise taxes and cut spending. The countries that have successfully come out of this have essentially cut $3 of spending for every dollar of tax hikes they've done. And most importantly, all the tax hikes come from consumption taxes. If you raise income taxes, you lose money, because wealthy people, if you attack their income, they hire a better lawyer or they move. I have a bunch of friends on Wall Street that have permanent residence in Florida, and they have to spend, no more than 182 days in New York City. I mean, that's ridiculous. It's ridiculous because the tax structure encourages people to do that. But if you institute a goods and services tax or a value-added tax, and you put a gasoline tax in the United States, you go a long ways to fix their fiscal problems. So the U.S. is the most easily fixable, but has the worst political system. The problem with everybody talks about the President of the United States having the most powerful man on earth, or person on earth. And that's true if you want to go and shoot at somebody. But if you want to fix the economy, the president has virtually no power whatsoever. It's Congress that actually does it. And if you looked at the resumes of the 534 congressmen, I don't think virtually anyone would hire them to do anything. It's kind of an absurd political system, and but they'll figure it out. I think the U.S. But what is important is every country I've studied, the political will never ever comes voluntarily. It always comes from the market forcing it. So therefore, I think you have to anticipate that there could be some maybe relatively severe, if short-lived, disruptions in the financial markets, maybe even in the next 6 to 9 months. But America will get their act together, as Winston Churchill said, when they've exhausted every other option to do that. But and China, I'm actually going to China on Saturday, and I was there about 5 or 6 weeks ago, and I met several government officials there, and it's a very interesting place. I think that China is undergoing they're going through a leadership transition, which they do about every 10 years. And they're also very afraid of two things. I met very senior government officials, and they all said the same thing. We're afraid of two things. Well, actually, we're afraid of one thing, and it manifests itself two ways. We're afraid of social unrest. And the things that will cause social unrest in China are either a shortage of food or a real estate bubble. And they're very, very afraid of a real estate bubble because they've looked at every financial catastrophe in the world in the last 30 or 40 years, and virtually every one of them has come from overinflated real estate prices and leverage that goes along with that. So they need to slow it down. But they also say, don't forget that we have 300 or 400 million citizens that are living a subsistence environment in a rural area that we need to move to urban centers that we haven't even built yet, and we need to provide jobs for them, and not necessarily manufacturing jobs, but more service-related jobs. So I think China is likely to continue to be weak for the next 2 or 3 quarters, but longer term, I think all the things like the resource sectors that China is driving, that process is still intact. And I think over the next 5 to 10 years, you're going to see China continuing to be the engine of economic growth in the world. Just don't expect it maybe in the next 6 to 12 months.
All right, do we have time for one more question? One more question. Yes.
Gary, your point about needing possibly having market forces causing unrest. The fact that the central banks are now buying treasuries and kind of suppressing that market force, what do you think the potential outcomes are? And does it move forward from a 6 to 9 month time horizon to whenever markets finally do revolt, becoming something bigger?
Yeah, well, it's a very good question related to, the central banks are extraordinarily aggressive because they don't want to get into a financial market problem. And, if you see historically what's happened is people have refused to buy a country's government bonds. Like in Canada, we had 14% interest rates in the early 90s, and the US had 6% interest rates, and the two countries had the same GDP level and the same inflation rate, yet Canada's rates were twice as much. The difference was Canada was at 90% debt to GDP and US was at 35 at the time. So there was a buyer's strike in Government of Canada bonds by foreign investors. And so the argument, and what you're asking about is how can US Treasury bond yields rise 2 or 3 or 400 basis points if the Fed is buying them all? And that's true. If the Fed is going to buy all the US Treasuries, the only other safety mechanism is the US dollar. And if nobody in the world wants to buy a US government bond other than the US Federal Reserve, who's printing money, eventually there'll be a massive loss of faith in the US dollar as a store of safe haven. And people will go to gold, and they'll go to the Canadian dollar, and they'll go to the Swiss franc, and they'll go to the Norwegian kroner, and all the countries, all the low debt to GDP things. And that probably would have happened in a normal world already. The problem today is all the major currencies are horrible. You have a choice between the euro, the dollar, and the yen. And those are the 3 biggest problems in the world. So, and that's why gold has gone from $400 to $1,700 because all the currencies be devalued. So either there's going to be a problem in the US government bond market because the Fed has stopped buying them, or if they keep buying them, eventually it comes out in the currency. And, you know, but this could carry on for, you know, I think it's going to happen around the election and next year, but it, you know, I could be totally wrong. I mean, this could carry on for another year or two before something else could happen that would start this discipline, or maybe the U.S. politicians actually just do the right things. There's no basis in history for that to happen, but it doesn't mean it can't happen. I'm skeptical.
Well, hopefully that clarified your investment choices in fixed income this morning. I'd like to thank our panelists, Barry Allen, Alan Weiner, and Richard Pilzoff. Thank you very much.